China's second quarter 2025 economic data has been released, and the numbers paint a stark contrast to the reality of the Chinese economy, a tale of two extremes, hot and cold. Today, I'll methodically unpack China's manipulated economic figures from imports to GDP using statistical cross-verification and probabilistic reconstruction to correct the distortions created by the Chinese Communist Party. Let's begin with the CCP's official report. For the first half of 2025, GDP grew by 5.3% year-on-year. Consumer spending rose by 5%, an increase of 0.4% from the first quarter. By location, retail sales of consumer goods in urban areas also grew by 5%, while rural sales increased by 4.9%. By category, retail goods sales rose by 5.1%, and catering revenue climbed by 4.3%. On the export front, customs data for June 2025 shows a total import and export volume of $535.6 billion, up 3.9% year-on-year, a 2.6 percentage point rise from May. Exports alone reached $325.18 billion, up 5.8%. Exports to the U.S. dropped by 9.9% in the first half of the year, while exports to the EU surged by 7.7% and those to ASEAN grew by 17%. Is this accurate? It appears the primary role of the CCP's Statistics Bureau isn't to compile accurate data but rather to produce figures that seem to mock the intelligence of Xi Jinping. Today we'll debunk the CCP's import and export data. As for consumption figures, disproving them is straightforward, though it requires minor adjustments to the calculation model. Let's start with the claim of a 17% increase in exports to ASEAN. Trade data from ASEAN, whether from individual countries or aggregated, shows no evidence of this 17% growth. ASEAN's data indicates growth between 10% and 12%, far from 17%. The purpose of this fabrication is unclear, as the discrepancy is easily exposed by comparing trade partner data. Evidently, the Statistics Bureau assumes the Chinese public won't cross-check figures or analyze them as institutional investors would. Even more absurd, China's exports to ASEAN haven't increased, and ASEAN's trade deficit with China is actually narrowing. This means China's reported $110 billion trade surplus in June is pure fiction. Aggregating import data from the customs authorities of the 10 ASEAN nations, we find that in the first quarter of 2025, ASEAN's imports from China totaled $136 billion per ASEAN's official website. Second quarter data for ASEAN as a whole is still pending due to adjustments among member states. Meanwhile, China reported $146 billion in exports to ASEAN for the first quarter. For the second quarter, summing the individual ASEAN countries' data, their imports from China for the first half of 2025 totaled $277.20 billion. Let's round it to $280 billion. Yet China claims $323.9 billion in exports to ASEAN for the same period, inflating the figure by at least $40 billion. Examining ASEAN countries' import data from China, aside from Vietnam, where the discrepancy is within a 3% statistical margin, the rest are overstated by 7% to 9%. This resolves my doubts. In truth, China's exports to ASEAN in the first half of 2025 likely didn't exceed $280 billion, meaning the CCP inflated monthly exports to ASEAN by about $6 billion on average. Turning to the US, the numbers are even more exaggerated. US imports from China, which stood at $40 billion in January 2025, have plummeted to around $20 billion, a 50% drop. These figures come from other countries' import data. I no longer trust China's numbers, which border on the fantastical and are unusable. How severe is the decline in China's exports to the US? It's comparable to the worst months of the COVID-19 pandemic, yet China's official May export figure to the US was $28.8 billion, inflated by $8.4 billion, a roughly 40% fabrication. This isn't a statistical error, it's numbers conjured from thin air. Chinese state media claims the year-on-year decline in exports to the US is narrowing, yet no report or official disclosure mentions trade volume data for the US. It's conspicuously absent. When something seems amiss, there's usually a reason. Digging into US customs data, June imports from China were $25.8 billion, slightly up from May, but still roughly half of last year's levels. Here too, the CCP has exaggerated the decline in US exports, adding flair to their figures. From January to June, comparing official data from both nations and factoring in port docking fees, China's fabricated data amounts to $16.4 billion. The most striking case is exports to the EU. China's foreign minister, in a bold statement at the China-EU summit, declared that Russia must not lose the war and that China cannot afford the cost of Russia's defeat. Now let's examine Europe's imports from China. The CCP's claims aren't just exaggerated, they're delusional. State media asserts that China's new energy vehicle exports to Europe in 2025 grew by 60% to 89%. Reports consistently tout export growth but waver on the exact figure. Some say 60%, others 89%. Regardless, they claim rapid growth. With China-EU relations so strained, could China's electric vehicle exports to Europe really have surged by 89%? Europe's own import data tells a different story. In the first half of 2025, Europe's imports of electric vehicles from China fell by 38%. This suggests either that vast quantities of electric vehicles were shipped to Europe to inflate numbers and are languishing uncleared at ports, or they were shipped out, circled back to China, and used to claim subsidies or tax rebates. The trade volume discrepancy is even larger. Over 6 months, the cumulative difference totals 17.1 billion euros, or about $19.8 billion. In the first quarter, China's current account surplus was $118.5 billion, exactly offset by a capital and financial account deficit of $118.5 billion, a perfect balance. Behind this web of fabricated data lies an attempt to conceal two things: foreign exchange reserves, closely tied to exchange rates, and China's true economic growth. Exports are virtually the only sector of China's economy still functioning. Over the first half of 2025, China's export data has been inflated by $75 billion to $80 billion. China reported total exports of $1,809.8 billion, averaging $301.6 billion per month. Subtracting the $80 billion in fabricated data, the monthly average drops to $288.3 billion, and even this is likely overstated. The Statistics Bureau's fabrications are remarkably crude. In the first quarter, the goods trade surplus was $238 billion, boosted by a rush of exports in March to dodge high U.S. tariffs. The first quarter current account surplus was $165 billion, fully offset by a capital and financial account deficit. A perfectly tidy balance, as if the CCP were building Lego structures. Even using the CCP's own import and export data, and assuming capital flight continues at the first 3 quarters pace of $165 billion to $170 billion per quarter, China's second quarter balance of payments would range from $0 to $20 billion. This is based on the CCP's own figures. Now, things get intriguing. China's first half data reports a goods trade surplus of 4.21 trillion RMB, or about $585.9 billion. April's trade surplus was $46.2 billion, May's was $56.5 billion, and June's soared to $114.7 billion. Summing April, May, and June gives $217.4 billion. Adding the first quarter surplus of $237 billion, the half-year trade surplus should be $451.7 billion. Yet the reported figure is $585.9 billion. The Statistics Bureau has produced shockingly amateurish data. Even using the CCP's own April, May, and June totals, plus the first quarter surplus, the half-year trade surplus should be $451.7 billion, already inflated by $75 billion to $80 billion based on other countries' data. Yet somehow, an extra $130 billion was added from nowhere. Through meticulous data reconstruction, China's half-year trade surplus is, at most, $451.7 billion. Subtracting the $75 billion inflation, we're left with $376.7 billion. The revised first quarter figure wouldn't exceed $190 billion, and the second quarter would be between $180 billion and $190 billion. Even using the CCP's reported $237 billion trade surplus, the combined capital and current account balance is zero, as clearly stated in the first quarter data. In reality, comparing with other countries' import data, China's first quarter financial and current account balance should be around negative $30 billion. The second quarter's shift wouldn't be much larger, between negative $20 billion and $30 billion. This explains the CCP's foreign exchange reserves. Despite no major spending and strict currency controls, China's reserves, with a reported $585.9 billion trade surplus, grew by only $100 billion in the first half of 2025, from $3.2 trillion to $3.3 trillion. That $100 billion came from a swap facility with Hong Kong's financial authority. Given the Statistics Bureau's poor record on verifiable data, China's reported foreign exchange reserves are undoubtedly fabricated. Reserves must account for both current and capital accounts. If the underlying data is false, the final figures can't be true. This leaves China with one tool to prop up its economy: falsification. So, what are China's actual foreign exchange reserves? After deducting the inflated trade surplus and fabricated trade volumes, we start with $3.3 trillion, subtract the $210 billion difference between $585.9 billion and $376.7 billion, leaving $3.09 trillion, an optimistic estimate. Our critique of the CCP is grounded in robust data. I hope this analysis proves insightful and helps you better understand the CCP's actions. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.